Accounting for current liabilities. So we're going to start with unearned revenues. Unearned revenues are the revenues that are received before the company either delivers the goods or provides services. So customer pays the company before they earn their revenue. So the types of businesses that typically will have unearned revenue are airlines, magazines, and hotels. So for example, an airline, you pay for your ticket before you go ahead and fly. So when they receive the money, they will debit unearned ticket revenue, they will credit unearned ticket revenue, right? Because it's a liability. And what they'll do is they'll debit cash. And then when they go ahead and perform the service, then they will debit this account to zero it out and they will credit ticket revenue. Now, magazine publishers, same thing. You pay for your magazines in advance. When they receive the money from you, they're going to debit cash and they'll credit unearned subscription revenue. And then when they mail out an edition, they will debit this account to zero it out and credit subscription revenue. And the same thing for hotels. Here's our example. Superior University sells 10,000 season football tickets for $50 each for its 5-game home schedule. And the entry to record the sale is, so we take cash, multiply it by 10,000 tickets that were sold, times $50 for each ticket, I get $500,000. I then will credit my unearned ticket revenue for $500,000. As each game is completed, Superior records the recognition of revenue with the following entry. We're going to debit unearned ticket revenue for $100,000. So they collected $500,000 for the 5 games. After each game, they're going to record 1/5 of the revenue. So here's 1/5 of the revenue. We're going to debit that to reduce this. And then what we're going to do is credit our ticket revenue for $100,000. Okay. All right, so let's go and to the ladybug. Okay, so let's go ahead and solve the first problem. Derby University sells 4,000 season tickets at $210 each for its 12-game home schedule. Give the entry to record A, the sale of the season tickets, and B, the revenue recognized by playing its first game. So here is A, and here is B. Okay, so they sell 4,000 season tickets at $210 each for its 12-game home schedule. Give the entry to record the season tickets. So the first thing we need to do is calculate out how much cash they received, right? So they sold 4,000 tickets, so we'll do 4,000. Multiply that by the $210 that it costs for each season ticket, and that's going to give me $840,000. Okay. So this happened, they didn't give us the date, so we'll just put an A in there. How much did they sell? So they sold $840,000 worth of tickets. So we're going to credit our cash because that's how they got paid. And we're going to credit unearned ticket revenue. And that's $840,000. Now part B says give the entry, so A is to record the sale of the season tickets and B is to record the revenue recognized by playing the first game. Okay, so let's now calculate out how much we're going to earn for each game. This $840,000 is for the entire season, and the entire season is 12 games. So what I need to do is take my $840,000. I'm going to divide that by my 12 games. And that is going to give me $70,000 that I earn per game. So it says here the revenue recognized by playing the first game. Remember, recognize means record. So we'll put B here. So the first game, they're going to reduce this liability. So if you remember, unearned ticket revenue is a liability. We owe that money to the customer until the game is played. So we're going to reduce our liability by debiting it. And we are going to credit ticket revenue because we have now earned that revenue. Okay, next, let's go back to our PowerPoint. So, current maturities of long-term debt. So when we talk about long-term debt, those are mortgages, those are bonds, things that we will repay in greater than 1 year, right? So for it to be a current liability, that means it has to be paid within the next year. So we do have some longer term debt that will be paid in greater than a year. However, like if you know a car loan or a mortgage, you're going to have some payments that you're going to make in the next year, and then you're going to have payments that you're going to make in greater than 1 year. So the payments that we're going to make in the next 12 months or the next year are called the current portion of the debt. Okay, so they're the current maturities of the long-term debt. No adjusting entry is required, but we do on our balance sheet have to show what portion is going to be paid in the next year and what's going to be paid after that. So if you can see here, Wendy Construction issues a 5-year interest-bearing $25,000 note on January 1, 2019. This note specifies that each January 1, starting January 1, 2020, Wendy should pay $5,000 of the note. When the company prepares its financial statements on December 31st, how much is the current liability? It is the amount that they're going to be paying within the next 12 months, which is that $5,000 recorded here. And then how much is going to be reported as a long-term liability? The $20,000 that is going to the remainder of it. So I get that number by taking my $25,000, subtract out my $5,000, I get $20,000. Okay, so let's go ahead and talk about how current liabilities are reported and analyzed. There are times when there are uncertainties, and those are called contingent liability. So it's a potential liability that may become an actual liability in the future. And there are 3 levels of probability: probable, reasonably possible, and remote. And there are things that we just don't know. For example, if we're the manufacturer of a vehicle and we provide a warranty, we don't know how much the warranty claims are going to be. So it's items such as that. Potential lawsuits, right? Someone tripped on your front step, got injured. You don't know if they're going to sue us or not. So here's the probability. So we have probable. That means it has to be accrued or put in the footnotes. Okay, so when something is probable, like warranty, we do accrue it, right? Because we know we're going to have warranty claims, we just don't know how much. So we would accrue that, and we would put a note in our financial statement. So let's say, for example, reasonably possible. Someone comes into our store, they trip and they get hurt. We don't know if they're going to have a lawsuit or there's additional, maybe there's some medical expenses or such, but it's reasonably possible. Then we would just want to put that in the footnotes to the financial statements to let the users know that there is this possibility. And if it's remote, we're just going to ignore it. So let's talk about product warranties. So that's a promise made by the seller to the buyer to make good on a deficiency of quantity, quality, or performance in a product. So if you guys have ever bought a car, usually cars come with warranties, and if something breaks down that's, covered by the warranty, they will fix it. Same thing with homes. Some products will come with a warranty. If you buy something through like a computer through Costco, they're going to stand behind it and then they will fix it. The same thing, like I've bought a computer from Dell, and in the first year it needed some work. They stood behind it, they got it fixed. So that's what a warranty is. Now remember, we talked about the matching principle, and when we talked about the allowance for doubtful accounts. We want to match the expenses in the period in which the sale happened, right? So if I sell a car and I know based on past experience that 1% of the cost of the car is what I incur in warranty expenditures, I'm going to accrue for that when I made the sale or at the end of the year that I made the sale. So Denson Manufacturing sells 100,000 washers and dryers at an average price of $600 each. The selling price includes a 1-year warranty on parts. Denson expects that 500 units, or 5% of them, will become defective, and that the warranty repair costs will average $80 per unit. In 2020, the company honors warranty contracts on the 300 units at a cost of $24,000. Denson records those repair costs incurred in 2020 to honor contracts on the 2020 sales. All right, so we estimated a total cost of $24,000 for our warranty work. So we're going to debit our warranty expense and we're going to credit warranty parts, because they just have the employees that are on the line fix it, but they have to pay for the parts out of pocket. On December 31st, to accrue the estimated warranty costs on the 2020 sales, less the amount already honored in 2020 of $24,000, we're going to compute it as follows. So we sold 10,000 units, 5% of them are expected to be defective, which is 500 units. At a cost of $80 per unit, that gives me $40,000. We've already paid the warranty claims of $24,000. So what's left at December 31st that has not been incurred is $16,000. So what we're going to do is debit warranty expense and credit warranty liability. So this is the liability that we estimate will occur in the following year. Okay. All right, so now let's do our exercise. So let's go to the ladybug. Unfortunately, the camera I have at home is not as good as the one in the classroom, so it's a little grainy, but hopefully you guys can see it all okay. On December 1, Bruni Company introduces a new product that includes a 1-year warranty on parts. In December, 1,000 units are sold. Management believes that 5% of the units will be defective and that the average warranty cost will be $90 per unit. Prepare the adjusting entry on December 31st to accrue the estimated warranty cost, assuming that no warranty claims have been honored to date. Okay, so the first thing we have to do is calculate out how much that we estimate will be our warranty costs. Okay, so we have to prepare the adjusting entry as of December 31st. All right, so we know that 1,000 units are sold, and we believe that 5% of the units will be defective and that the average warranty cost will be $90 per unit. So I'm going to calculate out how much I estimate my expense to be, and that's 1,000 units times 5%, okay, that we expect to go bad. So here's my 1,000 units, here's my 5%, and the average cost is $90, and we multiply that by our $90, and that is going to give me $4,500 of estimated warranty costs. It's December 31st. We're going to debit warranty expense, and we're going to credit warranty liability. And the same 4,500. Okay, so that is warranty costs. Let's move on to our next learning objective. Hold on, let's just talk briefly, about what it looks like in the balance sheet. Here it is as a current liability, warranty liability. And here's unearned revenue, and here's current maturities of long-term debt. All right, how to report payroll. So learning objective 3 is all about payroll. So payroll means salaries and wages. Salaries are managerial, administrative, and sales personnel that get either a monthly or a yearly amount. So normally it's stated as a yearly amount, like, $40,000, and then it gets translated down to each pay period. Wages are the rate per hour. So if you're paid hourly, you're paid wages, and if you're paid salary, it's called salaries. So when we're determining payroll, we're going to calculate out three amounts. We have gross earnings, we have our payroll deductions, which include taxes and benefits and such. And once we subtract those deductions from our earnings, we get our net pay. So here's how we calculate our gross earnings. So gross earnings is our total compensation earned by an employee. That's either their wage or their salary plus any bonuses or commissions. Now salaries are easy. You just make, let's say you have a $12,000 a year salary. You divide it by 12, they're paid $1,000 a month. Okay, so that's easy. When it comes to gross earnings, it's a little more challenging when we're talking about wages. So we're going to do an example here. This is how many hours. So let's say this employee worked 44 hours in this pay period. So you're paid regular pay for the first 40 hours you work in a week. So this person earns $12 per hour, so their regular hours are 40. They get $12 per hour, so now their gross earnings are $480. Now when an employee works more than 40 hours in a week, they get paid overtime. Now, just a side note, some states, right, this is regulated by the states, not the federal government. Some states require when an employee works more than 8 hours in a day, they get overtime. In the state of Arizona, it is more than 40 hours in a in a week, sorry. Okay, so this person, as I said, worked 44 hours. That means they're entitled to 4 overtime hours. Overtime hours are paid at time and a half. So you take your regular rate and you multiply it by 1.5 and you get the $18, and that's where I got $72 for my gross wages. My gross earnings. I add those together and I get $552 as my total wages. Okay, so we take our gross pay, we subtract out our payroll deductions, and our payroll deductions, the mandatory ones are FICA taxes, federal income taxes, state and city income taxes. And then we have some optional: insurance, pensions, union dues, and charity. So I take my gross pay, subtract out my deductions, get my net pay. So let's talk about some of our deductions. We have FICA tax. FICA tax is actually Social Security and Medicare tax combined. Okay. Social Security tax is what pays for the Social Security benefits for the retired for retired people. It's supplemental retirement. It's also disability. So if someone becomes disabled, they can get Social Security. And then the Medicare portion of that pays for the medical benefits. So here is how we calculate out the two components of FICA. So Social Security and Medicare make up FICA. The Social Security tax part of FICA is 6.2% of wages. Okay, so remember, this is just the Social Security portion. The employee pays 6.2% and the employer also pays 6.2%. And it is paid on the first $127,200 worth of wages. So someone who earns above that amount stops paying the 6.2% once they reach this amount of salaries or wages paid. Now Medicare, there is no limit. It's paid on all wages and it's 1.45% on all salaries and all wages. And again, both the employer and the employee pay that. Federal income tax. Employers are required to withhold income taxes from employees' pay. Withholding amounts are based on gross wages and the number of allowances claimed. There is a table that you look up. There's also computer software that calculates it. You'll be given the amount. State income taxes. Most states and some cities require employers to withhold income taxes from employees' earnings. In the state of Arizona, we only pay taxes to the state of Arizona. I'm from New York, and when I lived in New York, I paid state of New York taxes and city of New York taxes because I worked and lived in New York City. So I had to pay the city tax as well. So here is how we calculate out the net pay. We calculated the gross earnings as $552. Then we calculate our FICA taxes of $42.23. That's, remember, Social Security and Medicare added together. Then we have our federal income taxes of $24, state income taxes of $11.04, United Fund, that's a charity, $10, union dues, $5. We add all these together, we get $92.27. Subtract that from our gross earnings and we get $459.73. This is what an employee earnings record looks like for the whole year. So here's this pay period. The employee worked 44 hours. They got 480 in regular pay, 72 in overtime, 552 total. Cumulative, this is what they've been paid year to date, because remember, we have to keep track of that in calculating out our FICA. And then so they got $516 in their first paycheck and $552 in the second, and so that's $1,068. This pay period they paid FICA of $42.23, federal income tax of $24, state income tax of $11.04, United Fund, union dues $92.27. Subtract it, and they are going to get a paycheck with $459.73. And the check number is 1028. And this also gives us the information, the Social Security number, date of birth, and exemptions, so that we can calculate out the federal. Then each pay period, the company does a payroll register for everyone in the company. So this is all the employees, how many hours they worked, what their gross, their FICA, income tax, United Fund, union dues, net checks. And then what we do is we total it up for the period, and that is how we record the employer's journal entries. So Academy makes the following journal entry to record the payroll on the week for the week ending January 14th. We debit salaries and wages for $17,210. We credit FICA taxes payable of $1,316. Now let's talk about that for a moment. So here FICA tax, we're withholding it from the employee's paycheck. And if you remember our conversation on sales tax, we don't get to keep the sales tax, right? We're an agent for the state that we operate in, and we have to collect it and give it to them. It's the same thing with payroll taxes. We don't get to keep the payroll taxes. We're collecting them on behalf of the federal government or the state government. So we take them out of the employee's paycheck and we put it in this liability account because we need to pay that to the federal government at some time in the future. So here's our FICA taxes payable. Goes into this liability account. Federal income taxes payable goes into this liability account. State income taxes payable, United Fund payable, and union dues payable. So everything we withhold from an employee's paycheck goes into a liability account waiting for us to pay it. Generally, it's paid once a month, but sometimes things are paid each pay period. And then the remainder, so I take my $17,210, subtract out all my deductions, and this is the net pay that's going to all the employees. And if you remember this register that we did right here, okay, the net pay is $11,522.73. That goes to the journal entry. Here's my gross earnings, $17,210, and my total of my deductions for each FICA, federal, state, union dues, and United Way. Okay, so that all comes from the register. Prepare the entry Academy Company would make to record the payment of payroll. Salaries and wages payable, cash. So we're going to debit salaries and wages payable because now we're paying it. So we're going to debit the liability to reduce it and credit cash. And here's what the paycheck looks like. All right, so let's go ahead and let's go to our Ladybug. So compute gross earnings and net pay. Beth Corwin's regular hourly wage is $16 and she receives an hourly rate of $24 for work in excess of 40 hours. During a January pay period, Beth works 45 hours. Beth's federal income tax withholding is $95. She has no voluntary deductions and the FICA tax rate is 7.65. This 7.65, okay, so remember FICA equals Social Security plus Medicare. So if you saw here, 7.65% equals the 6.2% of Social Security tax plus the 1.45% of Medicare tax. So you only have to worry about the 7.65. They want us to compute Beth's gross earnings and her net pay for the period. Okay, so her regular hourly rate is $16 and she gets $24 for hours in excess of 40 and she worked 45 hours. All right, so let's calculate her gross. Okay, so in calculating her gross, we need regular hours. Okay, and so she worked 45 hours, so she'll have 40 regular hours times her $16 per hour, and that is going to equal $640. Then she has overtime, which are 5 hours, because remember, she worked 45 hours. I'm going to put it right here. That's 45 minus the 40 regular hours. That's how we got the 5. And it says here that her hourly rate for overtime is 24. It's just time and a half. and that's going to give us $120, and so her gross wages are $760. Okay, so she gets paid gross wages of $760. Now let's calculate out her net pay. Her net pay is going to be her gross earnings which is $560. I'm sorry, $760. Okay, 760, and then she has some deductions. Okay, so the deductions are, she's got federal income tax of 95, and she has no voluntary, and then her FICA is 7.65%. So we're going to do federal income tax, and that's 95, and I'll put it here because we have to subtotal it. And then we have no voluntary, but we do a FICA. And remember, the FICA is 7.65%. And so I'm going to put a star here. And I'm going to take her gross, which is $760. And I'm going to multiply that by the 7.65%. And that's going to give me $58.14. So we're going to put $58.14. So her total deductions are $153.14. And then her net pay is $606.84. So that's her net pay. Net pay $606.84, and gross wages are $760. Okay, hopefully that makes sense. So now we're going to record a payroll and the payment of wages. Let me just move that up a little bit. Data for Beth Corwin are presented in 11-7. Prepare the journal entries to record her pay. So we're going to have A, we're going to record her pay, and B, the payment of her wages. And it's saying use January 15th for the end of the period. So let's do January 15th. This one is A, which is the her pay for the period. Okay. So that is going to be salaries and wages expense, $700 we are debiting because it's an hour expense. Then we have FICA taxes payable. Right here, what was our FICA? $58.14. Then we have federal taxes payable, and that is $95. And then we have salaries and wages payable, and that is going to equal 606.86. That's an 8. And that is my net. This is my net pay. These are my deductions, and this is my gross earnings. So now we're going to record Part B. Part B is the payment of Beth's wages. So we've already recorded her gross, her deductions, and we recorded the liability, right, of salary and wages payable, what we have to pay her. Now what we have to do is record actually paying her. So this is part B. And we paid her on the 15th of January. So we're going to debit our liability so that we can clear that out. We can zero it out. And that's 606.86. And we are going to credit cash because we're going to pay our employees in cash. That's what they want. 86. Perfect. All right, the last part we're going to talk about is the employer liabilities. Okay, employer payroll taxes. So employers, when they hire someone, they have to pay payroll taxes. Okay, and the payroll taxes are FICA taxes, and it's paid at the same rate and the same maximum earnings as employees. So whatever they take out of the employees' paychecks, they basically match that. Then they have federal unemployment tax, which is referred to as FUTA, F-U-T-A. That's what it's abbreviated at. And then we have state unemployment taxes. And state unemployment taxes are called or abbreviated as SUTA, S-U-T-A. So we talked about what the rates were under FUTA, right? So they were, under FICA, I'm sorry, the federal unemployment tax. So for the FUTA tax rate is 6.2 of the first 7,000 of taxable wages. So we only pay unemployment taxes on the first 7,000 of wages. This is, as I said, the unemployment tax, and it's only paid by the employer. Without getting into anything complex, employers who participate in their state unemployment tax, which in Arizona employers are required to participate in state unemployment taxes, they get a credit, so the ultimate rate they pay is 0.8%. Don't worry about knowing these facts because it'll be given to you. Now for the state, right, we also, only the employer pays it, not the employee. And the basic rate is around 5.4%, also of the first 7,000 of wages paid. This is a number that'll be given to you as well because it can vary. So the employer has 3 payroll taxes: FICA, state unemployment, and federal unemployment, and they're all based upon wages. So Academy records the payroll tax expense associated with the January 14th payroll with the following entry. So you're given FICA at 7.65%, state unemployment at 5.4%, and federal unemployment at 0.8%. So here is how we're going to record that entry. So we first have to calculate our FICA taxes payable. So we do that by taking our gross payroll. Nobody was over the cap. No one was over that 127,200. We're going to multiply that by 7.65%. We get 1316.57, and we'll put that there. Next, we have the federal unemployment taxes payable, and we calculate that as the same gross. No one was over 7,000 because it was the second pay period of the year. We multiply that by 0.8%, and we get 137.68. And then our last is our state unemployment taxes payable. Once again, we take our 17,210. No one was over the 7,000. We multiply that by 5.4%, and we get 929.34. All right, so let's go ahead and go and do our last exercise. And it's recording. Hopefully that looks a little better. Okay. Recording gross earnings in Lugo Company. Okay. So gross wages, let me move that down a little bit. It might look a little bit. There we go. In January, gross wages for Lugo Company totaled $80,000. All earnings are subject to 7.65% FICA, 5.4% unemployment, and 0.8% federal unemployment. Prepare the entries to record the January payroll tax. Okay, so the first thing we have to do is calculate out how much our taxes are going to be. Okay, so FICA, right, we had gross earnings of $80,000. We're going to multiply that by 7.65%, and we will get 6,120. FUTA, which is federal unemployment, we'll take the same 80,000, right? It's our first paycheck of the year. So everyone is subject to it, and it says that right here. All earnings are subject to FICA, FUTA, and SUTA. So I will multiply that by my 0.8%, and that's going to give me $640. And then my state unemployment tax, same 80,000. Multiply that by 5.4%. Once again, 7.65, 5.4, 0.08. And that is going to equal 4,320. So I'm going to put here January 31st. And I'm going to debit payroll tax expense, right? Because these are the taxes that are paid by the employer. So it's an expense on their books, and it's 11,080. That just means this plus this. I'll put this right here so you can see it. It's the sum of these numbers. So then I have FICA tax payable. Remember, I have to pay this to the federal government, 6,120. FUTA tax payable. I also have to pay this to the federal government, $640. And then the last one is SUTA. I have to pay this to the state government. In our case, it would be the state of Arizona, $4,320. And that is how you record the employer taxes.